I think the fundamentals always are what I'm going to focus on because ultimately that's what's going to drive the markets.
For sure.
And
because we don't know, the fundamentals might be changing and the market might be ahead of how we view the fundamentals, right?
It could be, but look over the past week, the fundamentals we've gotten. Last Friday, the jobs data that came out, a good number, a little bit below expectations, but you could say some of that was hurricane related. CPI yesterday, a little bit below expectations, dovish. The market, like the futures are up, so we're not getting the inflation pressures. Overnight, the data out of China, all consistent with kind of a global economy that's still doing quite well. Slowing, but the fundamentals are good. That hasn't changed over the past 2 weeks. What's changed, and certainly what's happened yesterday, if you look at the tape, the movement seemed to suggest entirely sort of like program selling, sort of risk selling. The volatility in the Nasdaq day to day was like a sawtooth, right? So that doesn't seem fundamental based. That seems more technical based. So the fundamentals haven't really changed. That gives me comfort that this is more a replay of what we had in January or February. Rates moved rapidly, you had a correction, it takes time to digest, and then you move forward.
What do you think? Where are you? You just buy stocks when they're cheap that you like?
We're very fundamentally oriented as well and long-term oriented. So we're looking for fundamental value and making sure that while the markets are running really hard, that we're careful to manage our valuations on the upside. But this gives us a chance to look at stocks that are beaten down a little bit. And quite honestly, we're strategic investors, and we see acquisitions even in markets like today. We have a stock that got bought today, a little company called Corium, a pharmaceutical company. And so what it means is we've got to keep our focus on the long term, keep focused on the fundamentals, and there's still a lot of great companies there. The economy is still strong.
You think there's bargains just because of a 5% pullback, or you're talking about the individual stocks that have performed much worse within those indices? Yeah,
I'm looking more at individual stocks. We're not, trying to guess day to day because, quite honestly, I don't think I'm that smart. But maybe long term, I can have a different strategic view than other investors, and that's really where we try to make our money.
It seems easier, I guess, to live in your little world than
so sometimes you just you have to just turn off the monitor and get back into the box,
I don't know
right?
if you need to really go that far. I mean, you can leave, you put the mute button on or something. You don't have a Nielsen box, do you?
No.
Okay, all right, well, then turn it off, it doesn't matter. So at this point, would 15% surprise you? That's what we were talking about earlier.
A 15% total downside?
Yes.
I think that would be extreme. I could see getting into 10%. The S&P
moved up. I mean, the Nasdaq moved up 50%.
Yeah, but like the S&P is down about 7% over the past 2 weeks. So we're back to kind of early July levels.
Do we need to shake out complacency? Is that what we're trying to do here? Or what?
I mean, we're not.
What's the end goal in sight for these corrections?
Right now, I think we're just adjusting to the higher rate environment.
20 basis points higher, 30 basis points.
Well, that's one factor. The other factor, I think, is on the trade side. You're starting to see some companies give a little bit of guidance in terms of how the tariffs are impacting them. We looked at a basket of stocks that are most exposed to China versus the market that have been outperforming. The past 2 weeks, you've seen significant underperformance. So there's probably a little bit of pricing in the trade risks. Combined with a rate move, that leads to some fundamental weakness, but not a significant deterioration of the story. On the valuation point, I think it's interesting that after this pullback, the forward multiple for the S&P 500 is around 16.25 based on 2019 earnings. The long-term average is 16. So it's hard to look at the market and say this is really expensive given where we think earnings are going to go. So it's not cheap, but it's really not expensive. It doesn't seem there's a lot of sentiment in the market that says this is frothy at all.